the market has been ignoring this risk overall over the last month. There is a real push and pull between optimism that global growth is going to continue to mosey on above 3%. We are a little bit more pessimistic about that, and we believe overall that this is going to be a demand shock to the global economy. The longer that this proceeds, then you're going to see global growth get marked down substantially.
So I'm curious, there has been a scenario over the past several months where we've known the trajectory of this virus, yet it has done nothing to shake the markets until today. What exactly was then the proximate cause in your mind for why we are selling off 700 points at this open?
Well, Dominic, everyone thought, or not everyone, but the masses thought that this was going to be contained in China. And now you're starting to see it spread into other investors' backyard, which is a real shock to demand. Not only that, but for capital investment as well. So, yes, you could have monetary policy that is extremely dovish across the globe, but when demand falls precipitously, that's the real issue.
Viewers and listeners have been listening to this show, and I've said in the past, there has been no real losing trade over the course of the past several months. Gold has gone up, treasury bonds have gone up, stocks have gone up, but now there's a divergence. So what exactly do you do given the current environment? Do you go into bonds and gold, or do you go into stocks, defensives? What exactly is the playbook now?
Well, you know, if you're overweight aggressively on equities as well as momentum stocks, you want to modestly start to shift your portfolio. Keep in mind, we're up over 30% over the last 18 months within the global U.S. equity markets. So we're recommending that investors go into more quality investments, look at investment-grade bonds instead of high-yield bonds. We would eliminate the emerging market trade and overweight U.S. dollar-denominated assets and just move up the quality spectrum. Go into some of the consumer staple names.
Like what?
Pepsi, for example, or Coca-Cola, Procter & Gamble. You can get a good return overall over the next 18 months and move away a little bit from the more high momentum companies, those story stocks that are trading at 50 times PE multiples.
You're not worried that those defensive consumer staples are overvalued at this point?
No, because a lot of them are not holding a lot of debt on their balance sheet. So yes, you're looking at a PE multiple, but if you were actually looking at their enterprise value to cash flow, you conclude that these steady Eddie companies have a great consistent cash flow stream, rising dividend, and they're reinvesting back into their business. And that's the critical thing that investors are forgetting about.